Good afternoon, everyone. It's Jared here again from Alpha Capital Group, running through another weekly market roundup for the trading week ending today, 28th of July. So 28th of July brings the close proximity to end of another trading month, another very, very volatile month in the financial markets, despite obviously what you would expect to see during summer volatility. Now today we're going to be recapping along the fundamentals this week in terms of three interest rate meetings: the Fed, ECB yesterday, and the Bank of Japan overnight. The earnings reports that has been coming out all week, we talked about it last week in our roundup, and looking at it this week in the daily market notes in terms of the intraday volatility associated to the bigger stock market earnings. And of course, we'll be talking about that briefly. And then also some of your other data, like, for example, the higher than expected growth in the GDP, and of course the overall market dynamic in terms of how the markets are currently faring out into, as I said, the end of another trading month. So really, without further ado, looking at the markets this week, as I said at the beginning, there has been three very, very clear interest rate meetings this week. Of course, Wednesday evening we had the volatility from the Fed, increasing rates by 25 basis points, more than likely in signaling that it's the end of the cycle. Now, whether we get the end of the cycle or not, I think the next 6 weeks will probably tell a very, very strong tale in terms of the economic data, i.e. inflation, and obviously the continued growth figures in August. But naturally enough, then the idea then turns to forward guidance. Okay, so the forward guidance given on Wednesday is the sense that the Fed's hands in terms of increasing the rates, in terms of having that hawkish approach, is very much tied because, of course, the inflation is coming down relatively quickly. They mentioned that on Wednesday. Even though they are continuing to raise rates, the next month, really August month, in terms of the inflation data is going to be pivotal because, of course, if we see the similar decline as what we saw in July, headline inflation going from 4 to 3%, core inflation going from 5.3 down to 4.8, we see that continuing to decline as aggressively as it's done so over the last, let's say, 3-4 months in particular, but through the course of 2023. Then that's going to really put their hands tied to say, well, do we need to really increase another 25 basis points? Current estimations is that we could very easily be in line for a pause come September. So we are approaching the last of interest rate meetings before a lot of institutional traders head away on holidays, vacations, with many people heading away during the month of August, and that will go to central bank speakers, of course, as well. Now, Wednesday, turning our attention to the ECB, yes, we did get 25 basis points increase by the ECB. Of course, previous data was at 4% on the ECB with 3.5 at deposit facility. Of course, we got 25 basis point increase in both deposit facility and the main refinancing operations rate. So Europe is still raising rates 25 basis points. So all we've really done is match that of the Fed on Wednesday. And I suppose the forward guidance for the rest of the year is how many more interest rates does the ECB have, considering they were so far behind the curve in terms of how aggressive the Fed was in raising those rates as quickly as possible. And we've obviously seen that as well in the US in terms of mortgage rates, repayments, the price of debt financing obligations, as the higher interest rates means higher capital repayments on those mortgages. Now, with that in line, of course, we've had the BOJ overnight again tonight, 8-1 in terms of the vote in voting members by the BOJ overnight. Decided to leave rates at negative 0.1%, as we've seen for the last nearly 30 or 35 years now, but we have seen movements in the Japanese government bond yields, and of course that is very much impacted upon the yen pairs, as you'll see aggressively yesterday. Rumors started to circulate yesterday. We started to see the yen pairs become very, very aggressive sell-offs, and of course with dollar yen, we'll look at that now shortly. Pound yen, euro yen, we saw some fairly significant movements in very, very short periods of time on the yen crosses yesterday by virtue of some of the commentary, some of the updates provided by, as I said, overnight BOJ regarding its government bond yields and the capping of those said yields. Now, given that we've had 2 interest rate hikes by Europe, by the Fed, next obviously turns to the Bank of England again, and will they match? And of course, that's really the expectation in Europe, that the Bank of England will continue to raise rates, at least matching that of European Central Bank and of course the Federal Reserve in the US. So after the central bank meetings, we've had a raft of other data points this week. Of course, we've had a lot of data out in Australia, particularly during the Asia sessions. We had PMIs on Monday, which all come in. A lot of them come in less than expected, which didn't really have trading in the early parts of the week. However, if you look at broader US indices, and particularly if you look at the S&P or the NAS, the tech, we have seen indices just continue to grind higher, right? That broader team in market dynamic over the course of the month has just continued to progress to the upside. The old additive of sell in May, go away, it seems to now be turning into the fact of buy in May and go away, because of course through the month of May, through the month of June, through the month of July, all we've really seen is the stock market indices, S&P, the NAS, the Dow Jones, even the European counterparts, the Footsie getting back into some of those short-term highs, the Dax getting back into all-time highs, and even the Euro Stoxx yesterday making new all-time highs in that index. So very much seeing that bullish sentiment, that broader macro bullish trend coming into play. And despite interest rates at 5.5%, which is quite bizarre that the Fed can raise rates continuously to 5.5 basis points, but yet we see the stock market's up 700-800 points in the S&P since March, is truly incredible. That a lot of what's going on is market makers, is liquidity providers, is broader investor sentiment. And of course, through the last 3-4 months, we have seen investor sentiment pile into the stock markets. And you only have to look at the movement in the NAS over the last 3 months, which we'll show you now shortly, that progression back off of those lows and up back close to all-time highs, which again shows that the volatility, as we always say, isn't always just on the downside and when the markets are in stock market declines and bear markets, but also during peaks and troughs. And as I said, when you look at the March lows, we were 12,000 on the NASDAQ. Just a couple of months later, we are almost back into all-time highs, and we're sitting at this 15,800 level come the end of July. So again, reiterating that necessarily the market dynamic doesn't always do what you expect it to do, and that's why focusing on price action, looking and evaluating investor sentiment, trading sentiment, is going to add confluences to your market dynamic to give you clarity in terms of the execution. Yes, there might be short-term movements and off of data and fundamentals within the economic calendars. Yes, that's absolutely noted, but the broader trends tend to normalize over the higher time frames. And of course, as you look back 2, 3, 4, 5, 6 months of data, you tend to see that very clearly. So of course, with the data points this week, mix on some outperforming. Even yesterday, the GDP in the US was stifling. The fact that we went from 1.8% to 2.4% shows that from a broader perspective, if you're to believe the data at face value, growth is holding up relatively well. Inflation is coming down much quicker than expected, and of course, actually quicker than how fast it actually went up, which again shows how resilient the global economy is. And I would say as well, the fact that you have market makers piling in is definitely helping this situation, and looking at that broader dynamic. So as we move from the economic calendar, this week we've had Microsoft, we've had Meta numbers coming out fairly strong, residually done very well. We've had the Alphabet numbers also come out very strong. Microsoft numbers coming out very strong. So a lot of the earnings reports, broadly speaking, in the last couple of weeks, with the exception of maybe one here and there, have shown to be quite resilient. And again, is that euphoria of stock markets. We had it in 2017, 2018, into 2020. We had that stock market crash in 2020. We had that next impulsive wave higher in the indices between 2020 and really the end of 2021, beginning of 2022. And now we're seeing that next wave higher into the stock markets as these indices look to grind higher. So very much that investor sentiment is visible in these markets. Now, of course, we talked about it there, with the higher than expected S&Ps, with those indices continue to grinding higher on the day, Overall on the week, we're starting to see a little bit of a slowdown, a little bit of a pause in the S&P, but still holding much of its bid into Friday night's close or Friday end of trading session. We are seeing the Nasdaq get back to those highs of where we reacted from last Friday. So last Thursday and Friday, we sold off initially from 15.8. We came back down into this 15,400 level from where we've spent most of our week. If you look at the intraday basis on the week, very much back and forth between 15,400, 15,800. As price action navigates between the highs and the lows on the short term. Broader trend, of course, is still very, very much bullish. And of course, as traders, as investors, as market participants, we have to be uniquely very much aware of that. Okay, and of course, on the alternative viewpoint is the impetus associated to the dollar. Okay, because we talked about it last week, that massive sell-off. Could we find a little bit of a bottom? The answer to that was yes. We saw that decent rally into last week's close on the dollar as we closed at this 101 level. Now, as I said, this week with ECB, with obviously the Fed as well, we've seen a bit of chop and volatility back and forth. We had selling initially on Wednesday. That very quickly eroded on Thursday as the euro dollar sell-off started to ensue with dollar strength and euro weakness on Thursday afternoon, which fueled this next wave higher in the DXY back into the short-term top at 102. So you look at DXY now, we're not really any further along than where we were last week. It's still holding much of its bid in comparison to that rapid sell-off that we saw 2 weeks ago. So really now it's evaluating, well, as long as we're above 101, the likelihood is that we have the potential to grind up now. Although we have rejected 102 here, short-term area of liquidity, there is the potential to come and mitigate that 103 handle. And I suppose that becomes the upside target. If you are buying short-term dollar strength, that really becomes the narrative or the idea of where you're probably looking to run those positions. If you're on the other side trying to short it, where the carry and drawdown, or you're waiting for that narrative to end for the next wave low. And you can even see it here as well. Dollar strength into last week, a little bit of a pullback, new highs again to end the week. We're seeing that next wave higher. So we're seeing those higher highs, higher lows, higher highs. Visual trend is very, very clear. And of course, as market participants, we need to be looking at what is the price action actually telling us. Not trading what we think, we are trading exactly what we see. And that above all else is most important. Now, we migrate from the likes of the DXY into euro dollar, into cable. We are seeing, we talked about it last week, the potential to spot those declines in euro dollar, declines in cable. Last week, of course, we had the UK inflation figures, which really allowed that pound to create some meaningful downside retracements. And I'm sure you can see that as well last week. We did find a bottom. We had a little bit of a pullback. As I said, Wednesday into Thursday, aggressive new wave lower. So when you look at the broader perspective, zooming out for perspective can give you a little bit of an idea of what price action is looking to do. We had short-term lows earlier on in the week, short-term lower highs, new lows again. So it does look now that price action is continuing to create that counter trend, long short scenario. And now it's just a case of waiting to see how does that migrate into month end on Monday. But of course into August, which we know is probably tend to be one of the trickier months for trading because we tend to see market volume dry up quite significantly in comparison to other months. So you tend to see a little bit more wiki price action. You don't tend to see much volume or as much volume traded in the markets as you would normally. So of course you have to be wary of that as well. And I think at this point in time, it's really a case of, well, we are pulling back. We have created new highs, as we said 2 weeks ago. We're creating that pullback into the new lows. And now it's a case of evaluating where does this selling bias end from. Do we get to 127? That is the big question. We've obviously taken out or broken back underneath the previous highs at 128 temporarily. We are above 128 now as we speak, but can we create that next short-term lower high scenario to run this even lower? And if so, do we get to 127? Can we get to 126s for that next bullish wave higher? When you look at the broader time frames, you're seeing overall that the weeklies is holding up very, very nicely at 128. So I think a strong weekly closure above 128 this week is going to still hold up relatively firm, particularly when you look at that broader dynamic as well. 128, keep an eye on it and seeing can the price action continue grinding higher next week. And that would be the big talking point. Me personally, as always, using the higher time frames into lower time frames to establish really kind of key prominent areas of interest. You've got to be looking probably, as I said, that 127.50, 127, seeing do we get that end of this bearish wave for a change in cycle trend dynamics and then run it back up into those highs. Whether that plays out or not, let's wait and see. But we have to be nimble. We have to be nimble enough to react to those market conditions and those changing dynamics within the markets. Moving on now is dollar yen. So when we look at the dollar yen, we talked about it Thursday. We started to see rumors in terms of change of policy regarding the yield curve, the government bonds in the Japanese markets, the JGBs, and of course what happened yesterday. We had that massive unwind back down into the lows here. Now, when you look at the broader dynamic, what has it done? Well, the sell-off yesterday has allowed that short-term retracement. It's only really come back into these lows down here. And this was an area that I had looked at from our reactions around that 120, 138, 138.50 level. And as you can see, those wicks have come aggressively into that value area, taking out the liquidity very, very nicely, mitigating this initial impulse we saw through the earlier parts of the month and the mid parts of the month, only to create that alleviation and downtrend last week. Now, of course, as you see it clearly, we've seen the bottom coming through. Buyers are now back in control, taking us back into 141. And when you look at that broader dynamic, given that we've taken out the lows, given that we've taken the liquidity, can the price action now take out some of these highs, 140, 141, and elevate for another upside run? It sure looks like a potential probability. But let's see, can we break structure of this bearish retracement that we've seen through the course of the week from last Friday into yesterday? Can the price action break out through this? And if so, then we have the directional bias set for next week, and then we can look for price action to really try and take out these short-term highs at 142 and continue progressing potentially back into these highs again, 144, 145. So let's wait and see how that one plays out. If you're looking at the short 1 hour order flow, very, very wicky yesterday, of course. You look at some of these 1 hour wicks, very, very, very choppy. Like that wick alone, 139.70 is roughly the top of the body, goes up to 141. So that's a 130 point move higher, only to quickly unwind. And of course, on the downside as well, you can see how aggressive that is. So that is just pure market manipulation, higher volatility associated to macro fundamentals tied into the back of it as your catalyst, as your narrative. And of course, as I said, Friday afternoon, we are seeing dollar yen rally up. So now, as I said, it's just all about evaluating the price action. Can we get a reaction here? We've created short-term highs again. Can we get another reaction? Can we start to see buyers coming back into the markets? And if so, can we start springboarding up to really take out this liquidity here and start progressing to the upside? And that becomes the big talking point on dollar yen, on the yen crosses, particularly after the back of the fundamentals that has taken place over the last 24 hours. The Aussie, last in the FX markets, just before we finish with gold, and just a quick run through those indices again. The Aussie has been very, very choppy, very, very volatile, as we know, with the movements, that the inverse correlations in the DXY very, very clearly, very, very poignantly moving over the last couple of weeks, dependent on which way the narrative is poised. As you'll see, the Aussie dollar has seen some very aggressive selling yesterday from the 68s. I did mention last week just to keep an eye on these areas up here. So you're really looking for evaluations of lows, off your value areas, and then of course off your tops. And as you look left, we've made short-term highs back into your value area, marginal new highs again, all the way back down into this liquidity area down here around 66.50. And that is exactly where we've held and rallied from initially into the early parts of this week. So worth keeping an eye on the Aussie. As I said, the Aussie is finding a lot of value down here around 66.50. We're now sitting around about 66.70 into the end of the week. So I think a nice little closure tonight in the Aussie could we start to see that consolidation down here then next week, and maybe start to see that inflection back up again, because of course the Aussie has been very range bound, very up and down between the 69 handle and the 66.50 lows that has been holding very, very prominently over the last 6 months or so, pretty much since the middle of June. All right. Now, last on our list, in terms, just before we look at the indices and before we wrap up today, is the gold markets, because the gold markets has been incredibly volatile, as always, with the inverse movements in the DXY. So of course, if the DXY is moving higher, you tend to see those weaker movements in gold. If the DXY starts to sell off, you tend to see those gold prices exaggerate and continue trending to the upside. Now, if you look at gold prices, what have we seen? As I said yesterday, very, very aggressive sell-off from this 80 handle. In fact, if you were to look at the order flow, you'd say, well, short-term highs, short-term lows. And then, of course, we get that inflection point yesterday where price action came back up, insinuating that can we start breaking higher? Can we maybe take this trend higher, take out this, create a new higher high? Because, of course, high, low, new high. But, of course, that didn't happen. Price action failed here very, very vividly. reacted off of this liquidity area up here, just underneath the 1980 level, and we had that implode back down into the 50s, into the 70s, 60s, 50s, and we found a little bit of a bottom, ironically enough, just below these lows around 1945. Now, since then, again, the market dynamic is buying gold again. After we've made new lows, after we've taken out these lows here and this short-term low here. In fact, I can even draw it out for you. Here and here, we're seeing this dynamic come back up again. So worth seeing if there's any sort of reaction up around here, because of course those crossover points in sentiment become important. Buying ends, selling comes in, buying ends, selling comes in, buying ends. But where is the buying going to end? If I was an optimistic person, I would probably say somewhere around that 1970, 1975 level. So do keep an eye on this region next week, because of course gold prices is rallying at the minute. It's about $10, $12 away, so worth keeping an eye to see, does the gold prices get back up to that region. And then of course you've got short-term lows, lower highs, lower lows, lower highs. Can we then run it lower and get back into lower lows again, bring in the territory, and then have a pop at maybe mitigating this area down here? Okay, so worth keeping an eye on that one. Obviously quite messy there. Let me just tidy it up a little bit. But worth keeping an eye on that dynamic here on gold prices, somewhere there around that 70, 75 level. So keep an eye on that this week. Of course, to invalidate that selling bias in gold, you're really looking at gold prices taking out these highs at 82, 83, subsequently at 87, and then ultimately trying to continue higher beyond that. And that's really the narrative we need to look at. Now, lastly but not least is obviously the indices. So we said this week, S&Ps, NAS, the Dow Jones, all of these indices have been just continuing to grind higher. We talked about the S&Ps at that 45.75 level last week. Daily area, we're still migrating off that zone this week. We've been very up and down this week, very choppy at that region. It looks to be a case whereby price action is accumulating price volume around this 95, 75, 9600 level. And of course, that's exactly what we talked about last week. You've got your nice little daily area over here, buying in, selling comes back in, and what goes down must come back up eventually. And that is exactly what's happened here in the S&Ps. We've come all the way back up. Now, of course, any closure through 4600 this week into today's weekly close really then brings in higher movements. Then you're looking at 47s, 4800s as the narrative, as the buyers remain in control, and that then brings in your all-time highs, your previous all-time highs from 2022. So at this moment in time, we're trying to grind higher. We've had a very, very positive week for the last 3 weeks consecutively. And now we're looking to see, can we affirm that really strong closure again today to give us that certainty into next week that the trend is still very much bullish. And as a result, we need to be looking for either trading with the trend or watching those short-term retracements back to short-term lows, like what we've had this week, like what we've had at the early part of the month in some of these indices, particularly obviously, as I said, S&P and now the NAS. So NAS is likewise, we reacted off of 15.8 last week. Double mitigation here around 14,450, 14,500. Clear low seems to be established. Buyers are very much pushing higher into today's close. And the big talking point is, can we take out these highs? Can we close the new highs? And that should become the focal point for traders into the end of this week, but also focusing on price action Monday into month end and setting the tone then for early August. Okay. Lastly then in the Dow Jones, very, very clear. Apex type structures, aggressive impulse. Monday and Tuesday this week, we got our top on Thursday morning. Sell-offs very, very aggressively Thursday afternoon. Where do we react from? Our weekly lows. We're straight off of that 35,200 level on Wall Street Dow Jones. US 30, price action migrating back up into buying control again. Created the highs, back down, mitigating all of this order flow on the week. And of course, market dynamic very, very aggressively again, grinding higher. And if you look at the short-term time frames, which is something I don't tend to do too often, you'll even see mitigation down here on the lower time frames, a little bit of a lateral move consolidation, aggressive breakout, creating short-term highs. What happens? We get back right to that crossover point in sentiment there around that 300 level. We actually did go lower than that initially, but on the second bite we got to 300s, and then that market dynamic has just gone 200 points higher since really this morning. This is at 9 o'clock this morning. The Dow Jones is now trading 200 points off of those mitigated levels just after the European trading open. Now, moving across to Europe, lastly, before we round out the week and we round out the month, the Footsie 100 has been very apexing and inversely correlated to that of the pound, because last week we talked about the pound movements, that weaker pound play, what has happened with the Footsie. it's just continued to grind higher. So last week was very clear indication that we had UK data last Wednesday, which is the real catalyst for that initial move. Then we saw it migrate up into where we've been for the last week. Now, if you look at the Footsie over the last 4 or 5 trading days, very little has happened. We're trading underneath 7,700. We're trading above 76, 76.25. So we've been in a 70-point range for the last week or so against what has been nearly a 350, 400-point range since those lows from the 7th, 8th, 10th of July. So now we're starting to see chop and volatility like you would expect after a fairly expansive impulse. From my perspective, I'm really looking at Footsie around this level here, around that 77, 77.50 to see, well, we've created new lows in the order flow. You've had cycle lows, back up, lower highs. We've had short-term phases of price action here, short-term lows, lower highs, new lows again. Can we come back up? Can we mitigate this here? We've taken out the liquidity here. Can we react from this consolidationary region here around 77.50? And of course, that will depend on cables. So if cable starts to find the bottom, we start to see that pound strength coming back in, that is going to be a clear idea that we should start to see Footsie maybe starting to evade, give back some of those profits that we saw through the month of July. Bit of profit taking before the month of July end would be the most likely scenario on the pension funds, particularly in the UK. And then seeing, do we start to see that sell off maybe Friday? Today, most likely not the case, but Monday, month end, can we start to see a little bit of selling coming through for UK pension funds? Let's obviously wait and see on that one. And then lastly, but not least, is the Dax and Euro Stoxx. So the Dax and Euro Stoxx are still holding a lot of its bid. European Indices are still holding a lot of its bid. A lot of its buying impetus. You only have to look at the Euro Stoxx this week in terms of creating new all-time highs again, and that has been very, very, very clear for these markets. Euro Stoxx above 4,400 for the first time, clearly, really ever. 4,450 has given way today after that initial break and shockwave. Yes, and you only have to go again, zooming out those impetuses. Very clear consolidation. A secondary pause over the last few weeks, but as I said, once we've taken out that 4,400, 4,420 level, we've continued to grind higher. And if you look at the price action over the last few days, very, very clear. Short-term consolidation, aggressive V-shaped recovery. So impulsing, taking liquidity in the downside, then breaking higher, coming back down to double tap. And since then, it's just been simple supply and demand price action, whereby we are now breaking through all-time highs and we are continuing to progress to the upside. So at this point in time, it's really just evaluating where does the next set of highs come from. Do we get that retracement, whether it's back down here to mitigate the impulse, or whether it's maybe back into these shorter-term levels. Of course, let's wait and see how that plays out next week. And then last but not least is the DAX again, which if we wait to weekly time frames, go left, you will see the DAX today also making new all-time highs again, and European indices continue to excel to the upside despite much higher interest rates in Europe, which is quite ironic when you look at it, that European indices are at all-time highs when European interest rates has been the highest it's been in over 15 years. And I think that's probably the best place to end today's Zoom. So obviously, as always, everyone trade safe. Risk management and the idea of discipline becomes so imperative. As we've seen, the nimbility of traders to be able to react to market conditions on both sides is extremely important. Markets won't always go the way you expect, and of course traders has to be very, very aware of that to manage risk, to be able to hedge out of positions and to not take on additional exposure that you are not comfortable taking on your book of business. So as always, everyone trade safe, have a good weekend, and we'll see you all next week.